3 margin hikes in just 30 days. A market structure designed to reduce leverage and force liquidations. And yet, silver prices are still holding near $71 an ounce. By standard futures market logic, this outcome should not exist, which is precisely why it demands attention. Margin increases are not subtle tools. They are blunt instruments used to cool markets, reduce speculative exposure, and drain excess leverage. Historically, when margins rise sharply and repeatedly, prices tend to fall as weaker hands are forced out. This time, that expected sequence has broken down. The silver market has absorbed 3 separate margin hikes in a compressed time window without producing the price collapse that traders have been conditioned to expect. Instead of cascading liquidations, price stability has emerged. That stability, under pressure, is the anomaly that frames this discussion. Markets communicate through behavior, not commentary. When policy tools fail to produce their typical effects, the signal matters more than the intention behind the tool itself. A market that refuses to move lower under tightening conditions is not behaving randomly. Silver has long occupied a unique position in global markets, sitting at the intersection of monetary demand, industrial usage, and speculative trading. That dual identity makes it especially sensitive to leverage conditions in futures markets, which is why margin hikes have historically mattered so much for price direction. In most prior episodes, rising margins reduced open interest, triggered forced selling, and pushed prices sharply lower. Traders learned to respect that pattern. The assumption became embedded in market expectations. Margin pressure equals downside risk. What makes the current episode different is not the presence of margin hikes, but the absence of the usual response. Despite rising capital requirements, futures prices are holding firm rather than unwinding. That disconnect between policy action and price outcome is the central issue. Price stability under pressure often suggests that selling interest has already been absorbed. It can also imply that marginal sellers are exhausted, leaving a market supported by stronger hands willing to meet supply even as conditions tighten. This does not imply certainty or prediction. It implies observation. When markets fail to follow established scripts, participants who ignore that deviation often do so at their own expense. The silver market is currently deviating from a well-known script. The significance lies not in optimism or pessimism, but in structure. Futures markets are engineered environments with clear cause and effect relationships. When those relationships weaken, it raises questions about where price discovery is actually taking place. The $71 level is not meaningful because it is high or low. It is meaningful because it persists. Persistence under pressure is a signal that deserves examination rather than dismissal. At this stage, the story is not about outcomes, forecasts, or positioning. It is about an observable divergence between expectation and reality. And in markets, divergence is often where the most important information quietly resides. Margin hikes in futures markets serve a very specific mechanical purpose. They raise the amount of capital required to hold a position, reducing leverage across the system. When margins rise, traders must either post additional collateral or reduce exposure. This process is designed to slow momentum and reduce risk, especially in markets experiencing heightened volatility. Institutions like CME implement margin increases not to predict price direction, but to protect clearing stability. When price swings accelerate or open interest grows rapidly, higher margins act as a safeguard against cascading defaults. In practice, however, margin hikes often function as indirect brakes on price advances. Historically, silver futures have been highly sensitive to these changes. The metal attracts leveraged participation because of its volatility and relatively low nominal price compared to gold. As margins rise, speculative positions become more expensive to maintain, and weaker participants are forced to exit. This exit usually expresses itself through declining open interest and accelerated selling. Traders reduce positions not because they have changed their outlook, but because the cost of staying in the trade has increased. The result is often a sharp price correction driven by forced behavior rather than fundamental reassessment. This pattern has repeated many times across commodity markets. Higher margins reduce leverage. Reduced leverage lowers risk appetite. Lower risk appetite typically translates into lower prices, at least in the short term. This is the logic that most market participants internalize. That logic explains why repeated margin hikes in a short period are generally viewed as a strong headwind. 3 increases within 30 days would normally be expected to drain speculative excess and push prices meaningfully lower. The absence of that outcome is what stands out. Despite higher capital requirements, silver futures have continued to find buyers near the same price range. Selling pressure has not accelerated, liquidations have not cascaded. Instead, the market has shown an ability to absorb tighter conditions without repricing lower. One explanation is that leverage in the system may already be lower than assumed. If speculative positioning had been reduced earlier, margin hikes would have less forced impact. Another possibility is that the remaining participants are better capitalized and less sensitive to margin changes. There is also the role of hedgers and longer-term holders. Unlike short-term traders, these participants are less influenced by margin adjustments because their positions are tied to operational needs or broader portfolio strategies. Their presence can stabilize prices even as speculative activity contracts. Open interest behavior becomes important in this context. If prices hold while open interest declines modestly, it suggests that selling is being met by demand rather than overwhelming it. That balance matters more than the margin decision itself. The key point is not to assign intent or motive, but to observe response. Futures markets are transparent in their mechanics. When a widely understood pressure mechanism fails to produce its usual effect, the market is signaling resilience rather than fragility. At this point, the futures market is not confirming the expectation of weakness that margin hikes typically imply. That does not guarantee future direction, but it does suggest that price is being supported by factors beyond short-term leverage dynamics alone. While futures markets reflect leveraged expectations, the physical silver market reflects immediate supply and demand. These are related systems, but they are not identical. Futures contracts represent promises to deliver, while physical silver represents metal that must actually exist, be stored, shipped, and exchanged. Paper silver trades in volumes that far exceed available physical inventory. A single ounce of physical silver can underpin many ounces of paper exposure. Under normal conditions, this structure functions smoothly because delivery demand remains limited and confidence in settlement is high. The current environment highlights stress within that structure. Physical silver is increasingly trading at prices that diverge from futures quotations. This divergence is not theoretical. It is visible in transaction data, dealer inventories, and premiums paid above spot. Retail and wholesale buyers are reporting premiums of approximately $15 to $30 per ounce over the futures-based spot price for standard bullion products. These premiums are not promotional or temporary. They reflect the cost required to source metal in a tightening supply environment. In secondary markets, where immediate delivery is required, prices have been reported in the $85 to $100+ per ounce range. These transactions do not set global benchmarks, but they reveal what buyers are willing to pay when availability becomes the primary constraint. Dealer behavior provides additional context. Many dealers are operating with limited inventory, extended delivery times, or outright stock shortages. Some products are unavailable regardless of price, which is a meaningful data point in itself. This condition suggests that physical supply is not expanding in response to price signals from the futures market. In efficient markets, higher prices typically attract supply. When that response fails to materialize, it indicates friction somewhere in the system. The key observation is not that physical prices are higher, but that they are disconnected. Futures prices around $71 suggest balance or moderation. Physical market prices and availability suggest constraint and urgency. These signals are not aligned. Such divergence challenges assumptions about where true price discovery is occurring. If the majority of volume trades on paper, but the marginal physical unit commands a significantly higher price, the benchmark may be understating real-world conditions. This is not a claim about intent or control. It is a description of mechanics. Futures markets prioritize liquidity and leverage. Physical markets prioritize availability and settlement. When conditions tighten, those priorities can produce different price outcomes. Premiums are not speculative expressions. They are costs paid to secure metal today. When those costs rise persistently, they reflect structural pressures rather than sentiment alone. At this stage, the physical market is not offering conclusions. It is offering data. Limited supply, elevated premiums, and delayed delivery are observable facts. Together, they form a signal that stands apart from futures pricing and warrants careful attention rather than dismissal. Divergence between futures pricing and physical market conditions raises fundamental questions about price discovery. Futures markets are designed to aggregate expectations and manage risk through standardized contracts. Physical markets reveal constraints, costs, and immediacy. When these two signals separate, the gap itself becomes informative. Price discovery relies on confidence that quoted prices reflect the ability to transact. If futures prices suggest abundance, while physical markets indicate scarcity, participants must decide which signal better represents reality. Over time, persistent divergence tends to force adjustment somewhere in the system. For institutional investors, this environment introduces risk that is not captured by volatility alone. Portfolio exposure based on futures prices may underestimate sourcing risk or delivery constraints. For industrial users, it raises questions about procurement planning and cost stability. Long-term investors tend to focus less on short-term price movement and more on structural integrity. Markets function best when benchmarks, settlement mechanisms, and physical availability align. When alignment weakens, confidence becomes conditional rather than assumed. This does not imply an imminent outcome. Markets can sustain divergence longer than expected, but divergence changes the distribution of risk. What once appeared stable may require re-evaluation under a different set of assumptions. It is also important to clarify intent. This analysis is not an argument for buying or selling silver. It is not a forecast. It is an examination of observable market behavior and the signals that behavior generates. Investors who monitor market structure pay attention to how prices respond to pressure. Margin hikes represent pressure. Limited physical supply represents pressure of a different kind. When both exist simultaneously, the interaction matters. The current configuration suggests that leverage reduction alone is no longer sufficient to dictate price direction. Physical constraints are exerting influence that paper mechanisms cannot easily override. That balance shift is subtle but meaningful. For market watchers, the takeaway is not urgency, but awareness. Systems under strain often communicate quietly before they adjust visibly. Ignoring those signals does not eliminate their relevance. Silver has historically been sensitive to changes in trust, liquidity, and settlement confidence. Those sensitivities do not guarantee outcomes, but they shape behavior. Understanding that context is more valuable than reacting to headlines. As markets evolve, participants who rely solely on conventional indicators may miss changes occurring beneath the surface. Structural signals rarely announce themselves loudly. They appear through persistence, divergence, and inconsistency. The market is not issuing instructions. It is issuing a warning. Those who understand how futures and physical systems interact will recognize the message not as a call to action, but as a reminder to watch structure as closely as price.